Hello, fellow intelligent investors. My name is René Salman, and today I want to discuss my 5 key takeaways from Warren Buffett's latest shareholder letter. So without further ado, let's jump right into it.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
So in one of my previous videos, I pointed out that the 13F season, so when superstar investors have to reveal what they have bought and sold in the most recent quarter. Well, the filing date of these 13F filings feels like Christmas to me. But I think Buffett publishing his annual letter to shareholders, which he usually does sometime in late February, is probably an event that is even more exciting for every fundamental investor. Now, before I get to my first key takeaway, please be sure to hit the like button and to leave a comment, because this would truly help me to crack the YouTube algorithm and reach more people. Thanks. So the first thing I noticed, so you can consider this my first key takeaway, was actually that Buffett did not talk about a couple of subjects. Topics that were the major news headlines of investing newspapers and online magazines in the last couple of weeks and months. Buffett did not talk about US politics, for instance. He did not talk about inflation risk or rising interest rates. He did not talk about Bitcoin, the GameStop mania, Wall Street bets, all of these topics. He did not mention specs, or he did not discuss any macro predictions. And he did not talk about COVID, besides maybe mentioning that he's quite confident that in 2020 there will be a regular and in-person Berkshire shareholder meeting again. So I don't know whether you are active on Twitter, but if you follow certain users that are primarily discussing investing-related topics, well, then your feed will likely show tweets that discuss all of the aforementioned topics. And I think in a way the fact that Buffett did not mention these subjects, he didn't really touch on them at all, stresses once again that we should treat these topics as noise. It's almost as if the topics the FinTwit community is fixated on can be considered a waste of time. Alright, so let's move to my second key takeaway. Well, it's not really something that's new to me, but Buffett once again commented on the performance of bonds, and he stressed the fact that stocks are the superior long-term investment. On page 5 of his letter, Buffett wrote the following: "And bonds are not the place to be these days. Can you believe that the income recently available from a 10-year US Treasury bond, the yield was 0.93% at year end, had fallen 94% from the 15.8% yield available in September 1981? Question mark. There's really not much to add here, but maybe for educational purposes, I would like to add 2 aspects nonetheless. First, let me show you a chart here. It's actually a bar chart race, and the chart shows that if we take everything into consideration and compare the performance of stocks to the performance of bonds, the long-term performance, I should say, one can conclude that stocks have cumulatively outperformed bonds by quite a wide margin. This visualization also shows how compound interest works wonders over time. The chart was put together by Mark Perry, and I will add a link to the article he wrote about the historical returns of stocks, T-bills and T-bonds to the description box below. Now, secondly, I just wanted to add that Buffett himself has actually referred to the long-term treasury bond rates as the risk-free rate. And Leon Cooperman, who is an American billionaire investor and hedge fund manager, he recently appeared on the podcast of the Boya Value Group. I can highly recommend this podcast episode. And during this conversation, Cooperman actually referred to bonds as a return-free risk tool, as opposed to a risk-free return tool. And I thought that was quite funny, and I wanted to share that with you. And to quote him here, he said the following: "I think bonds offer return-free risk. If you take the 1.45% treasury, the people buying treasuries that are taxable probably have a 40% tax rate. So you keep 60 of the 1.45, which is 84 basis points, and the inflation rate is running above 2%. Basically, you have a negative return on your capital." And with regard to stocks, he said, Keep in mind, the most important thing I'm going to say in this podcast is inflation over time is a friend of common stocks, because the inflation in a company's costs get incorporated in their selling prices, which lifts the nominal level of revenues and earnings. So if we now move on to my third key takeaway, then that would be that Buffett in a way hinted at the fact that Berkshire's greatest days are behind it. Now I'm aware of the fact that that is quite a provocative claim that I just made here, so let me back that up. Well, in the "A Berkshire number that may surprise you" section of his shareholder letter, Buffett highlighted that Berkshire owns the most American-based property, plant and equipment of any US company. Berkshire's depreciated cost of these fixed assets is $154 billion, followed by AT&T with property, plant and equipment of $127 billion. Now this sounds quite impressive, but Buffett also described what the best businesses in the world look like. In my view, this is actually the most educational passage of this year's letter to shareholders. So let me share this with you here. Our leadership in fixed asset ownership, I should add, does not in itself signal an investment triumph. The best results occur at companies that require minimal assets to conduct high-margin businesses and offer goods or services that will expand their sales volume with only minor needs for additional capital. We, in fact, own a few of these exceptional businesses, but they are relatively small and at best grow slowly. So what Buffett describes here sounds pretty much like a software as a service company or business model to me. And other tech businesses might also come to mind. Now you might find it odd that it took Buffett that long to start investing in tech. But Buffett has actually been quite vocal in the past about the fact that he doesn't really understand tech companies, that they are not in his circle of competence. And even though he did understand some tech businesses, he considered the price too high in the past and has actually admitted that he has made a mistake regarding certain companies. For instance, with regard to Google and Amazon, he said at the 2018 annual shareholder meeting, "I made the wrong decision on Google and Amazon. I made the mistake in not being able to come to a conclusion where I really felt that at the present prices, that the prospects were far better than the prices indicated." So overall, it is fair to say that Berkshire owns very capital-intensive businesses. Apple might be one of the exceptions, and maybe Berkshire's insurance business might be another one. But all of the other major businesses are relying heavily on fixed and tangible assets. The insurance business might be capital light too, as I just said, but it's also limited in terms of how fast it can grow. So I think it is fair to say that the companies Berkshire owns are mostly slow-growing firms that do not fit the description of the best businesses of the world that Buffett has described in his letter. So my key takeaway here is certainly that if Buffett would be starting his investment career today, he would probably build a portfolio of asset-light businesses. He would do everything he can to understand these business models, and he might even be able to understand them more easily today if he grew up in today's generation. All right, let's move on to my fourth key takeaway. Well, generally speaking, I think that a letter to shareholders is a very valuable resource to learn more about the key figure of a corporation. It is not only a great indicator of the CEO's opinion of the company, but maybe more importantly, you might be able to learn more about the CEO as a person, himself or herself. Unfortunately, most CEO letters are not very valuable, but some companies publish awesome letters to shareholders. And by reading them, you can truly get a sense of the personality of the CEO, especially if he or she is the founder of the company or at least a major shareholder. Because if that's the case, I would argue that the CEO letter to shareholders might actually be one of the most underutilized resources in all of investing. And Buffett's annual letters are probably the prime example. They are always great in terms of clear writing about complicated stuff. And moreover, you can tell that Buffett deeply cares about his long-term shareholders. He always communicates openly and he's always willing to admit mistakes. Just imagine if all the people in leading figures would be as candid as Buffett is. Let me just include two quotes here to prove my point. So here's the first one. "After decades of management, Charlie and I remain unable to promise results. We can and do, however, pledged to treat you as partners. And then Buffett admitted that he has made a major mistake. He was referring to the $11 billion write-down of his 2016 purchase of Precision Castparts. He essentially criticized himself for overpaying. He said, "The final component of our gap figure, that ugly 11 billion write-down, is almost entirely the quantification of a mistake I made in 2016. That year, Berkshire purchased Precision Castparts, and I paid too much for the company. No one misled me in any way. I was simply too optimistic about PCC's normalized profit potential. Last year, my miscalculation was laid bare by adverse developments throughout the aerospace industry, PCC's most important source of customers." So my tip here is that you think about Buffett's authenticity and humility the next time you hear or read about allegedly superstar investors who are showing off their six-pack on Twitter or are trying to sell you their spec, or maybe business leaders who are pumping meme stocks or cryptocurrencies on social media platforms. I would say at his core, Warren Buffett is simply a good person. Now, my last key takeaway is that Buffett is missing his longtime business partner and friend Charlie Munger. Or more specifically, he missed him during the 2020 virtual shareholder meeting of Berkshire. That's why the next Berkshire Hathaway shareholder meeting will be special. Although it won't be an in-person event, it will once again be streamed by Yahoo Finance. The virtual meeting will host Charlie Munger again, who will be on stage with Warren Buffett. And that surprised everyone. And what also surprised everyone is that the virtual meeting will take place in Los Angeles, and the two of them will take questions for around 3.5 hours. I think this once again stresses how much Buffett cares about the people close to him. Here's what he wrote in the letter. "And now, drum roll please, a surprise. This year our meeting will be held in Los Angeles, and Charlie will be on stage with me, offering answers and observations throughout the 3.5-hour question period. I missed him last year, and more important, you clearly missed him. Join us via Yahoo. Direct your really tough questions to Charlie. We will have fun, and we hope you will as well." And that should already be it for today. I hope you learned something, and as always, may your finances and investments prosper. Good luck.